Okay, so on this channel, we tend to talk about various types of income ETFs that have rather complicated strategies, like Divo and Jeppy, for example. By the way, in my last video, I posed a question as to whether or not I should invest in a 6% yielding tech fund, and the response was overwhelming. So quick little update, I now have BST in my portfolio, and I'm pretty happy about my purchase price because I bought it right here at $47.50. But this closed-end fund is another example of a rather complicated investing strategy. So in this video, I want to go back to the basics and see what it takes to retire just off of the S&P 500. Now, fair warning, this is going to be a pretty mathematical video, so mentally get ready for that. But in addition to the S&P 500, we're also going to do the simulation with the QQQ. This is going to represent first buying into growth and then selling and buying SCHD, which is a classic dividend ETF. And then we're going to do it a third and final time, but this time with XYLG, which is the S&P 500 covered call and growth ETF. So sit down, get comfortable, and if you guys enjoy the content, as always, leave it a like, subscribe, and let's get into this. Okay, so how to retire on only the S&P 500. So for my data, there's a bunch of assumptions. The first thing is that I'm going off of the 20-year total annual return rate, and that's represented right here in this piece of data. This is an awesome little tool because it pulls all the data automatically for you. I'll leave it linked down below. But we can see here that this is the S&P 500, and the time period is 20 years, with an annual return rate of 9.38%, over that 20 years. Now, the next assumption I have here is just to do with the dividend yield. So I'm going to be using the 5-year average, and it's going to remain constant. Now, this is the 5-year historical dividend yield of the S&P 500, and there is that inverse relationship with the price. So as the price goes higher, the yield comes down. But the average over the past 5 years is about 1.8%. And just for reference, if we zoom out to a longer time frame, this is the yield of the S&P 500 going back to the 1960s. And the general trend here is that it is moving lower over time. But again, for these simulations, I'm going to assume the yield is consistent at 1.8%. Now, for my models, in order to retire, I picked an income level of $30,000 per year. Now, I do understand that for some people, this is nowhere near enough, but the reason why I chose $30,000 as my baseline is because if you want to retire, $30,000 is probably enough to do it. Also, the other caveat here is that all of this income is just from the yield of the asset. So I'm not counting selling any shares, Social Security, a pension, anything like that. This is just 30,000 bucks of income from the yield, in this case, of the S&P 500. So if you work backwards to find out how much money you need in order to generate 30,000 bucks off of a dividend yield of 1.8%, that is $1,660,000. Now, the next step is to take these numbers and input it into a final investing calculator. For all of these calculations, I put in a starting portfolio value of 10,000 bucks. So altogether, you need to contribute $2,395 each month to achieve this end value of $1.6 million in a time frame of 20 years with this rate of return. Now, I did run the simulation one more time, but here I gave it 30 years of time, and now the monthly contribution is $826 per month. So there you go. That's how you can invest and retire solely off of the S&P 500 and the dividend yield of just a measly 1.8%. But contributing over $2,000 per month is unrealistic to most people, and the main issue here is that the dividend yield, especially recently, is just so low with the S&P 500. And this brings us to the second simulation. Here, the common advice is to first invest in growth, then sell out and transfer your assets into a higher yielding ETF. So for this example, I'm keeping it very simple, and the growth fund is going to be the QQQ. And again, we're going off of the historical annual return over the past 20 years. And with QQQ, the annual return is 12.81%. And when it comes time to retire, we're going to sell the QQQ and buy SCHD, which has a historical yield around 2.75%. So if you do the same math again, in order to achieve 30,000 bucks in income from just the 2.75% dividend yield, we would need $1,090,000. So putting that number into the calculator as the target, updating the annual return rate, that means we need to contribute $974 per month if we want to achieve this goal in 20 years. If we give it 30 years of time though, it's much more reasonable at only 200 bucks per month. Now, an important caveat here is that there's going to be a tax event as we sell the growth ETF and buy the dividend ETF. So we can see here that the total interest, or just capital growth, is going to be $846,000, and we have to pay a capital gains tax on that, usually of around 15%. So it's definitely something to keep in mind with this approach. Okay, but now let's move on to the third and final approach, which is definitely the most interesting. So XYLG gives you half exposure to the growth in equities in the S&P 500, and the other half is covered in calls in order to boost income. And to confirm this, we can see that over the past 1 year, XYLG has almost exactly half the price appreciation as the S&P 500 itself. But that's not the full return of this investment, because a major portion of the return is the boost in income. And that's why if we take a look at the total return of the S&P 500 over the past 1 year, as well as the total return of XYLG, they're actually pretty close. Now this is just 1 year of data, and unfortunately XYLG isn't that old, so I can't take a 20-year average. But luckily we don't need that much historical data because of the systematic approach of this investment. It's just half of the growth of the S&P 500 with covered calls, giving it roughly a 5% dividend yield. And coming back up to the example of this past year, QYLG captured 84% of the growth of the S&P 500. So here I'm going to use a few more assumptions. I'm going to assume that XYLG in the future is going to capture 75% the total return of the S&P 500 and have a dividend yield of 4.5%, which is a little bit less than what it is right now. So as we saw, the 20-year annual total return of the S&P 500 was 9.38%. So for XYLG, 75% of that is an annual return of 7.04%. So that's the rate of return we're going to use. And again, to achieve $30,000 of yearly income at a 4.5% dividend yield, we only need $660,000. So plug in all of that into the calculator. To achieve that in 20 years, you need to contribute $1,218 per month. And to achieve it in 30 years, $494 per month. So those are 3 major options you have when it comes to retiring. Each strategy has its own sets of pros and cons, and that's why if it comes to my portfolio, I invest in all of the above. So right here I have my recreation of XYLG, I have dedicated growth equity funds like VUG, and then I have more dedicated income assets like Divo. The income from assets like this will be reinvested in my portfolio to help with the compounding process. And if my growth assets do well over time, I will incrementally take profits and put it into my income producing assets to further raise my income. Definitely leave a comment down below. Let me know which approach you favor the most. If you're still watching and enjoyed, give the video a like, subscribe, and I'll see you guys in the next one.